Hello, everybody. Welcome to Wall Street Hackers, one of the most popular shows on the Pod TV network. I'm Nick Palavito. I'll be your moderator today as we go over up and down the streets of Wall Street with the Wall Street Hacker himself. He's a graduate of the UCLA with a degree in economics. He also received a law degree from the University of Miami and also received a master's of business administration from NYU. With that, 17 years on Wall Street, dealing with every possible investment you could imagine. We're going to imagine right now. We're going to bring in the hacker himself, Peter Bennett. Peter, back to the show. It's your show.
Oh, thanks, Nick. Yeah, I don't know if I could ever imagine, but we dealt with all kind of things from regular equities to swaps and all kind of things over my career. So introduction, welcome everybody. You can catch us on most of our distribution channels on every Thursday, almost every Thursday during the year, and also on Saturdays on some of our new distribution channels. So thanks for watching. So we'll begin with our favorite chart. I'm not sure we're going to have our chart, Kim, on today. She's the one who loads the chart, so I may have to hold them up. But so here's the first chart. This is always our theme chart. And what it illustrates is that over 50 years of history, you are a heck of a lot better investing in dividend payers and dividend growers compared to the equal weight S&P 500. So if you put just $100 into the stocks in 1973, it grew to about $4,000 in the equal weighted S&P 500, about $8,000 and change in dividend payers, and 13,000 plus in dividend growers and initiators. So to me, it's pretty clear where I want to put my stock allocations. Maybe I want a different risk profile, certain bond allocations, certain stock, but whatever stocks I want a dividend. If I don't get a dividend, I'm probably not looking at the stock. So the second chart, we have two of I think the best charts ever on the show. We're always giving evidence of our thesis, which we've had for a year and a half and mostly been right about the fact that the market's not going anywhere. It hasn't been up this year, but it was down since a year and a half ago. We lost a lot of money against inflation if you put your money in stocks generally, depending on which stocks, of course, but in general. So here's a really interesting chart from UBS. And what it shows, I've marked it at the bottom. You can show this is their aggregate recession odds model. And right now, they're saying, this came out about a week or two ago, I saw it, about an 80% chance of recession. Now, what's also interesting, though, about this is they predicted all the recessions in this model that actually happened. I marked them all. And the other thing is that out of the last 3 of 6 that they predicted, 3 of them were energy-based. So you had the Gulf War and you had other energy crises where OPEC raised rates. The other 2, by the way, you had the dot-com and the mortgage crisis. But this one, if we have a recession, will arguably be energy-based also. Gasoline prices are up about 50% in the last 2 years, and they could go a lot higher. Eventually, I think they will. So the market is not fully pricing in a recession. And then this is another chart. I had this on last week, but I had to bring it back. So this is the Microsoft trend line. The straight line is their earnings trend line, and the line that zigzag is their stock price. So you could see, if you're looking at this, that, and it's since 2016. So a few points here. Number one, I've been saying for the last few weeks, and then I saw the chart, tech is, everybody knows this, tech is the only thing driving the market basically for this year and a lot of the end of last year. And these tech price stocks are very highly priced. Their PEs are high, their cash flow is low compared to other stocks. They have to have tremendous growth, maybe perfect growth to outperform. Now, if I was going to bet on another sector besides the ones I like, which are safer, I think, I might look at tech. I'm not saying tech is bad. I'm just saying that if you look at this chart, which has been very steady, there were only 2 times when it, Microsoft, which is a quality company, I did own it for a long time, 2 times when it really jumped way over its earnings trend line. And this is the second time. So the interesting thing I did this week, I said, well, how much over it is it? And it's about 25% over the trend line. So if it returned to 25%, and I'm not saying it will, but it is a quality company, but if it returns, that would be a big drop. And if tech returns to their trend lines, my guess is the market could go easily back down to a new low, or, we could suffer losses anyway. And the market's very different. So I thought these 2 charts really sum up the risks. And on Monday, Barron's said that tech was a safety play, and they were trying to explain why the market is up, because money's moving into tech. But the thing is, I don't know how safe it is, really. Not safe from my perspective. I try not to lose money and don't often. So that's the market so far. This week, for the quote of the week, I really have a lot of words from Barron's Daily on Monday. And it really sums up what I believe is true. Now, of course, I'm picking it because it agrees with my position, but it has been right for a year and a half. And it talks about some other impressive authorities that seem to agree with me. So it says, Fed will pay a high price to bring down inflation. Investors should take note. Central bankers from around the world are gathering in Portugal this week to discuss the state of the world economy. The consensus seems to be that it is not good. European Central Bank President Christine Lagarde reiterated on Tuesday that the battle with inflation isn't over. And I would point out that we can take that chart down now, Kim. We're through with that. It's okay. We can take down the charts. We're finished with that. I held them up. Anyway, so Christine Lagarde said that, and then the IMF made, they said, controversial contributions to the debate. The deputy head told the conference that raising rates quickly to get inflation under control could trigger financial instability. I would footnote that with, yes, it's supposed to cause problems. See, the problem, I have to go off on a tangent here, but the problem is they're trying to have gain with no pain, but there's no pain, no gain, I believe, when it comes to this. It's not just a theory. It's 70 years of history that says every time they needed to have inflation, bring it down, this needed to have a recession. And I don't think the consumer is going to slow down until there's some actual economic effects. So we will see what happens, but it doesn't look good to me. Central bankers at the start of the hiking cycle, I'm continuing with the Barron's, seem to have spent too much time worrying about the nasty impact of interest rate increases. Much time was wasted talking about inflation being transitory, and rate hikes started too small. Yes, they did, as we were saying for the last year. The deputy head of the IMF again pointed out that inflation is taking too long to slow back to target, and that getting it there will probably require some damage to the economy. Yes, it will. The IMF concludes that Powell and Lagarde will probably have to tolerate too high inflation for longer than they would like. That's a message investors would do well to absorb. So, I mean, this is the point. They're just slow walking the process of pain, but they'll keep, by the way, Fed at this same meeting, I think it was today or yesterday, now Powell is saying 2 rate increases. And they're saying they keep pushing things out. In other words, they're saying there's going to be a slowdown in the economy, but now then they say maybe next year. He's saying now there probably won't be rate decreases at all next year. So the market is not pricing this at all. So we will see, but it's going to be a long process. And probably, as I've said, the market will either stay flat with the bulls and the bears just arguing, but the profits going down as they have been trending down, or at some point the market's going to realize this isn't a great picture for stocks, and rates will keep going up as I expect. So 5 most interesting stories of the week. This is a really interesting story. I thought 36 states are now putting extra charges on registering EVs. So that's because, first of all, the states get a lot of their revenue from taxing gasoline. But there's several points about this. One, EVs are expensive anyway. There's issues with battery life at the end, what you get for resale. But since states get a lot of their revenue, as people shift to EVs, the states are going to want that revenue back. So more states will probably add taxes on EVs, and also taxes on EVs will go up. Right now they're $50 to $200, I believe, a year, and that already. And the key point here is when they do cost comparisons between an EV and a gasoline-powered vehicle, they say, "Oh, we were going to save this much on gasoline," but they're not counting the fact that now the states are shifting those taxes because a decent amount of what you're paying for gasoline is federal and state taxes. So who knows? Maybe the Fed will want to tax EVs eventually too. But that again eats into the EV gasoline comparison. It's something really to consider if you're buying an EV. Interesting story number 2. The House passed the Executive in Need of Scrutiny Act, which requires that any federal agency that creates regulation, if it is over $100 million in cost, has to get congressional approval. Now, it went through the House, which is obviously controlled Republican. I don't think it's going to go through the Senate, but even if the Democrats in the Senate might want to do this, because eventually we'll probably have a Republican president, and then he'll be able to do a lot, just like President Biden is doing a lot through regulation. But I'm in favor of this kind of act for 3 reasons. Number one, agency bureaucrats are not elected. So it's not just a president. I mean, any bureaucrat can do whatever he wants, basically, as long as it slips by. Number 2, Congress is supposed to have the power of the purse. The executive branch is supposed to enact the laws and budget of the Congress. So that's what the Constitution says. And number 3, the budget deficits in the U.S. are so dramatically out of control, as well as in other countries, especially when considering off the books costs, unfunded liabilities for retirement or Medicare, depending on the country, and healthcare for aging populations. It's astronomical, and it's not going to make a big difference, but you need to be as efficient as you can, because the U.S., as they're saying up there, USA government is out of control, but so are other countries too. Again, I always point that out. Everybody says, "Oh, the U.S. deficits," but other countries have promised free healthcare for aging populations, and they haven't put any money aside for that either. And we're talking about every country I've ever looked at, which is a lot. I looked at South America, pensions and healthcare, Asia, Europe. This is going to be an issue. And in the end, but as a footnote, it'll drive down rates probably to 0, because the countries are not going to be able to afford to pay interest on these enormous liabilities. Interesting story number 3, the Hong Kong Department of Justice is sending seeking a court-ordered ban on internet firms, including Google, from distributing a song called "Glory to Hong Kong," which is a protest song. So censorship is such an issue, and now Google's, if it goes through and it's banned, Google's going to face an issue. Are they going to even continue in Hong Kong, or are they just going to pull out because now the government is telling them what they can and can't put down in terms of information? This is a big issue, as I believe we had a lot of censorship, as we discussed, of COVID issues in the United States. Government should not be telling internet providers what is the information they agree with. Story number 4, the Dodgers honored the Sisters of Perpetual Indulgence and LGBTQ Pride Night. The Sisters are a group of drag queens who dress up as nuns and mock the Catholic faith. And I'm not talking about a little bit. I mean, they are viciously attacking. It's dirty, sometimes dirty. It's something. But the Dodgers thought it was acceptable to put it on at their stadium. Unbelievable. I always said the world was always going to be strange when I was growing up. And until about 2020, it was really pretty normal. But now it's getting really strange, as we always expected, I think, years ago. And finally, for our humorous story of the week, I'm always going to try to close with the 5 most interesting stories with a little bit more of a humorous story. A group of vegetarians and physician vegetarians are criticizing a local Georgia baseball team called Macon Bacon because it glorifies bacon. Now, the team admittedly sells bacon steaks and bacon fries at its stadium, and Macon Bacon is refusing to back down. They're staying Macon Bacon. So that was kind of cute. Anyway, we'll take a quick advertisement and we'll be back with the investment of the week. It's one I really like. Hopefully I'm right, but I have a big allocation there. And then we'll have our panel discussion. See you soon.
One of the things that business owners forget a lot is to prepare for their own retirement.
Hi, my name's Nick Palavita, and today I'm with a very special guest, a certified financial planner, a chartered retirement plan specialist, and president of National Pension Partners, Max Couliet. Max, tell me what you do at National Pension Partners.
Well, Nick, we help successful small businesses and professionals put together retirement plans that provide them the maximum retirement benefits and big tax deductions at the same time.
Well, how do you do this?
Well, we get on an internet conferencing system with the client. We review their goals, what they want to accomplish, and then put together strategies to help them in implementing a retirement plan that benefits them, not everybody else.
Well, that sounds really good, but how much does this cost?
Well, it's really not bad because the first consultation is free. That allows us to go through and discover whether this strategy works for that business and for you as the business owner, and helping you maximize your retirement.
Well, Max, how do we get this free appointment?
It's really pretty simple, Nick. You can either go to our website below or call us at 877-252-1692, and then we can set up a time with either myself, Nick, or one of our other retirement plan specialists, another CPA or advisor in the office, to go over this with you and make sure it fits for you.
Hi, my name is Lewis Haupt. I work with National Pension Partners, and I work with businesses to allow them to put the maximum away that they can for themselves and to save taxes.
Hi, I'm Brad Coyle, and I'm the brokerage manager at National Pension Partners. We're always analyzing plan fund choices in order to ensure the participant's success.
If you want more information on how we can help you and your business put more money away in a retirement plan than you ever thought possible, contact us at the website below or call us at 877-252.
Okay, we're back. What to do, it really never changes, at least in the last year and a half. But one, as the stock chart we always show at the beginning, not that one. We're not doing it well.
How about this one?
This one, there you go.
My favorite.
You want to own dividend, exactly. You want to own dividend growers and dividend payers, and you'll get a huge return compared to equal weight, at least based on 50 years of history. Number two, you want to own energy. If we can take the chart down. You want to own energy because there's Kim. There you go. You want to own energy because there's going to be an energy crisis probably, since we've been underinvesting capital by 40% in energy, in oil and gas projects since 2015. That's a long time. It's going to catch up. So maybe next year, the year after, I wouldn't be surprised if oil goes up a lot. Plus, the pipelines are a great investment anyway, other than from a period of about 16 to 20, when companies just started cutting oil so much production. They generally got about 17% a year return. They have high dividends, they have utility-based safety. Let's get to the dividend stock of the week. This is a real favorite of mine. It's SRRTF, which is a Canadian company, but they own U.S. grocery-oriented shopping malls. So open-air shopping malls. And this groceries is, as I've been talking about for a few weeks, is one of my favorite sectors. I think that you can get a good dividend growth, or in this case, a high dividend too. So this is actually my largest non-energy, non-bond holding. I have about 9% of my asset allocation in SRTF, and I hold it in my IRA. That's because it has almost an 8.8% dividend yield. And my theory is if I get a high dividend yield than a pipeline or a grocery REIT, then I'd rather have some background sound if we can get rid of that. If we can get rid of the background sound, somebody, okay. So the thing is, if I have it in an IRA, I'm getting 8.8% in 11 years, I get all my money back. Or if I have a pipeline and I get 10% a year, I get it back in 10 years and I still have the stock. So if it's a safe company. So a quick disclaimer, especially for our new radio audience, which is growing on several distribution channels, including Spotify. Disclaimer: 1, it's only for entertainment. 2, there are no guarantees. You can never guarantee anything. Nobody can. If they say they are and it's not a CD, then they're not telling the truth. So this is just my opinion, and you should consult your financial advisor. So back to the grocery REIT. So what do I like about it? Well, for one, it has an 8.8% yield, which is being covered by cash flow. 2, it's 100% grocery anchored open air shopping centers, which I love because I've always felt like closed air malls, maybe people won't visit, but people go to these to get their groceries. They have built-in traffic, and at least what I've seen on travels and in my neighborhood, there's almost never a vacancy in these things. So seems very defensive, yet with an 8.8% yield. Again, in my IRA, I don't even pay tax on that right now, so I get my principal back over time. There is a potential 15% withholding tax from Canada, depending on where you're holding it and what country. But either way, that's a very high yield. Also, what I like about it is if you look at it, SRTF versus other REITs, it has very good ratios. And you go, why is the cash flow so much better than other, even open air shopping REITs? And why is the cash flow better? Why is the PEs better? My theory is it's Canadian, and so maybe some people miss it, but it's 100% US. Another thing I like is that they're Southern-based strategy. So a good portion of their open air shopping centers are in the southeastern US, some in Texas, some in the Northeast, but a good part of that is in the South where populations are growing, and land and shopping centers are expensive to rebuild. So the last thing that I like about it, I love about it, obviously, because I have 9% in there, hopefully I'm right, is that their rents are significantly below market value, and they have been. So they're every time a lease comes due, they're getting very nice increases, and they have high occupancy anyway, over 93%. But last quarter alone, the leases that came up came up with an 8.4% increase over expiring rent. So, and that's been the pattern for years now. So even if there's some inflation, if they can keep raising the rents to market rates, and inflation will even increase the amount that they can raise those rents, I love it. Anyway, it's a very conservative time for me, but this is one I feel pretty good about owning a percentage of my assets in. So now we'll get into the panel discussion of the week. I'm not sure whether we have 2 panel members or 3, but either way, we'll do it. So the question is, what is wealthy? And how much net worth is needed to be, quote, wealthy? Of course, this is a relative term. Quick background. Charles Schwab recently did a survey on their clients on wealth. Obviously, Charles Schwab's clients are probably a little more wealthy than the average person, I imagine. But it was an interesting survey, and I like the results. And the questions included, 1, whether the clients considered themselves wealthy, and what those clients who said they were wealthy, what their assets were, and also what they considered it takes to be wealthy in general. So before we release the results, which I know and Nick doesn't, let me ask you, Nick, don't worry, there's no wrong answer because it's all relative, but what assets does it take to be wealthy in America today? Yes, you, and you're muted.
Good idea to be muted on this one.
Exactly, because there's no right answer. And
there's no right answer. As they say, it just depends. Okay, but if you looked at the analysis by our friends at the IRS, if you want like top 1%, you're probably looking at incomes over 800,000, net worth over 8 million. Okay, and then you're probably in the top 1% in the United States, and you're probably technically wealthy. However, it goes back to it depends, because Peter, as you know, there's some people that will have that income and they spend it all and they're broke. Some people have that net worth, but they'll have highly leveraged assets.
Exactly.
And they could be broke tomorrow. In other words, one person was bragging how he had 25 million in debt, but has 30 million in assets. Well, that's a $5 million net worth.
Oh, no, but the question is what net assets? We're looking at net assets. Just
well, he had 30 million in assets, let's say, and he has 25 million in debt. He's got 5 million net worth, but he also has other assets, 3 million outside assets.
It depends on the cash flows then, as long as the cash flows.
His position could turn around tomorrow and be broke. And if you look at it, there's very famous people like Michael Tyson, Evander Holyfield, who one time made 500 million, but today broke. So
and filed bankruptcy. Many famous people.
Yeah, right. So it really
amazing list. Musicians, actors.
It depends. I mean, so
no, it's a totally relative question. But pick a number, Nick. What do you consider personally?
Well,
I'm just asking you personally. What do you consider to be wealthy? What amount?
The IRS would say 800,000 income, 8 million net worth.
8 million. Okay, that's above the average. But I thought this was an interesting survey and interesting questions. Anyway, so here's the results, and then I'll give you a few conclusions, which, by the way, do agree with a lot of what you were saying about relative wealth. I mean, it's a relative term. So 48% of Charles Schwab clients considered themselves wealthy. Again, these are clients who are above average, at least they have brokerage accounts, but they had an average net worth of $560,000.
Whoa.
Now, which is not so high in some people's mind. Here's what's interesting. So in answer to the same question, what they considered it to be wealthy, they said 2.2 million. So there's a huge discrepancy. In other words, they consider themselves wealthy at 560,000, but they considered that in order to be wealthy, you needed 2.2 million. So now the discrepancy, I see you nodding, it's true.
No.
There was a big discrepancy. But so first of all, the theories on the discrepancy is 70% said wealth is more about enjoyed experience, which I thought was interesting. So these people who maybe say 560 for themselves, they're enjoying their lives. They feel they have enough money, so they consider themselves personally wealthy. But they don't consider that to be the average. Other people need to be wealthy. 69% said that a healthy work-life balance is a greater driver of their wealth considerations than maximizing earnings. So again, it's lifestyle. And that's really my conclusion, which you started getting into. It's so relative because it depends on your lifestyle, what you need, what you want, and also where you live, because the same income in New York or California may not be the same lifestyle in another state. Some states it's just more expensive to live because of rents, taxes, home ownership. Everybody knows why. So my main conclusion, though, is that one, it's very relative, but I thought it was a decent survey, and I'll tell you why. I think 2.2 million is a fair judge for like wealth. We're not talking about extreme wealth, but if you have 2.2 million, you probably don't have to work necessarily. But again, it's also age-based, so it's such a relative thing. And I agree with you, Nick. But I thought it was an interesting survey, and so we'll get into more concrete issues as we usually do next week. Thanks for watching. As Kim always says, get healthy and get wealthy. And we'll see you next week on Wall Street Hackers. Thanks for watching.
We're going to leave this august organization then?
We are.
Oh, okay. Well, the thing is, I was going to talk about just that 2.2 million.
Okay, go ahead.
Peter, it's comfortable, but you're not wealthy. I still believe in the 8 million because there's some places.
Okay.
Some places, maybe if you're in Saline, Kansas with 2 million, you're probably okay. And you may consider yourself wealthy. But if you're in where I came from in Seattle just last week, if you had 2 million, lucky to be able to buy a house. Same.
Yeah,
with
that's
San Francisco.
true. You're right.
You're
It's such a
home.
relative thing.
Yeah.
I just thought it was interesting the results.
Yeah,
of this
right.
thing,
I'm not, actually, I'm shocked how low they consider wealthy.
You
to
know
be.
what? I agree with you.
Comfortable,
really.
maybe. Comfortable, maybe. Wealthy, no. Okay.
Yeah, exactly. Well, we're
Right.
getting wealthy in terms of lifestyle and
Right.
balance, or wealthy
Yeah.
in terms of
Depends your
you're not buying a
definition.
helicopter with either one.
No. All right. We'll see everybody next week.
All right.
Bye-bye.
So, okay. Well, again, we'll get into more concrete news issues and whatever as we usually do next week on Wall Street
Okay.
Hackers.
All right.
Thanks for
Bye.
watching again.